Okay, we are going live. We are going live. Welcome, everybody. I see people are entering the room. Really appreciate everybody being on time. I'm going to give it a few more moments for the room to fill up. And then we will kick off today's class. Really appreciate you guys coming and hanging out with me. Almost ready to kick off. All right. All right, great stuff. Great stuff. Welcome, everybody. Okay, without further ado, let us dive in to today's topic, goals and inefficiencies, the core of financial planning. The core of financial planning. It looks like all of a sudden people are doing financial planning. There's been a mad rush ever since the Nation program was announced. There has been a mad rush, people that are trying to get their financial plans done so they could see whether they can retire, what's the best strategy going forward. There has been a mad rush. And I want to tell you something, that the reason why I'm able to give this class is because, as I mentioned in the past, the work that I do is supported by my clients, my members, people who have done some form of financial planning with me. So if you know somebody who is a client, somebody who is a member of mine, do me a favor, give them a hug and say thank you. And if anybody here would like to become a client or a member, I'll actually show you how to do so. I'm going to put into the sidebar a button. So if you guys can see, I just published a button in the sidebar. If anybody is interested here in doing some financial planning, which I know that many federal employees right now, they'd like to get their numbers crunched. They like to organize their thinking about their finances, about retiring. And we're going to talk about that in today's class. But if you want the personalized version, you can request a one-on-one consultation. By doing so, by clicking on that button in the sidebar, it'll take you to a form. And if you submit the form, we could reach out to you and get you scheduled for the financial planning meeting. Okay, so let's get into the topic, goals and inefficiencies, the core of all financial planning. I will admit that financial planning used to have a bad reputation. The reason why it used to have a bad reputation is because it used to be you'd have these financial planners that would offer you a financial plan for free. And what they really were trying to do is they were trying to just have a conversation with you so they could sell you some product or some service which you didn't really need. Which I'll give you an example, an extreme example. One of my clients is a married couple. Both of them are federal employees. I believe she was in FERS, he's in CSRS. So they both have federal pensions. And somehow their financial advisor, the one that they were working with before they came to meet me, their financial advisor felt that it was worthwhile for them. Somehow he encouraged them that they should be liquidating their TSB, rolling their money over into an annuity. Now, if anybody knows anything about anything, you know that federal employees already have annuities. Your first pension is an annuity. And CSRS, we all know CSRS has an even larger annuity. And you also have Social Security. That's yet another annuity. And by the way, the CSRS people, they have something called the Voluntary Contributions Program, which is possibly the greatest annuity in the country. So it's questionable whether they even need an annuity at all. And if they did an annuity, he has the VCP, the Voluntary Contribution Program, which is possibly the greatest annuity in the country. And yet somehow this advisor probably offered him, I don't know the details, probably offered a free plan. And they came to him and he somehow convinced them that they should roll their TSB towards him, and he put them each into annuities. Really, it's unbelievable. It's unbelievable. And by the way, lest you think that these were just, uneducated people that were taken advantage of, I'm pretty sure she was a senior executive. I'm pretty sure he was a scientist. So we're not talking about people that are not educated, we're talking about people that are highly educated, and yet somehow In the financial planning process, they were convinced to do something which was probably against their wishes and probably not in their best interest. So it happens to be that financial planning used to have a bad reputation. However, I am now seeing more and more people seeking out the financial planning process because there are many benefits of the financial planning process. I would describe the two major benefits of the financial planning process is number one, measuring the feasibility of your goals, and then number two, removing inefficiencies. And that's what we're going to talk about today, those two things. Identifying your goals and measuring your your ability to achieve your goals. And then number two is removing any financial inefficiencies. So let's start off by talking about the starting point. The starting point of financial planning is to identify your goals. I'm sure some of you have many goals. And the truth is, some of your goals may have been disrupted by this deferred resignation opportunity. I have some clients that they had a goal to retire in 2 years or in 3 years or in 5 years from now. And had they retired in 2, 3, 5 years from now, they would have a larger pension, more savings in their TSB. They had a little bit of a different vision for their financial future. But now with the current environment, they're thinking to themselves, well, do I want to wait 2, 3, 5 years to retire? Can I even wait 2, 3, 5 years to retire? And now they're revisiting their goals. But nonetheless, the starting point is to identify your goals. What are your goals? That's not for me to tell you. That's for you to tell me. I could give you guys a list of some very common, very popular goals, but I really shouldn't do that. But I'm going to do it anyhow. See, here are a list of some very common, very popular goals. And you guys could add or subtract from this list. So, for example, first on the list, buy a home. Now, for some of you, it's going to be buying your first home. Some of you, it's going to be buying your second home. And by the way, for anybody here who's thinking that they're going to be buying a second home, well, if you're going to buy a second home, what's going to happen to the first home? So are you going to sell the first home? And if you do sell that first home, you have all the proceeds from the sale. What do you do with those proceeds? Do you plop it into the second home, in which case you have no mortgage? Or do you take out a mortgage on the second home? That's assuming that you're going to sell your first home. But if you're not going to sell your first home, so what's happening to that first home? Are you going to keep it as a backup residence? Or are you going to convert it into a rental property? And if you convert it into a rental property, is there any rental income? Any rental expenses? All these numbers need to be baked into your financial plan. Next, pay for college. It could be that your kids are almost done with college, or it could be that your kids are a distance from college. Whatever the situation, you need to define, what do you mean by college? Do you mean community college? Do you mean in-state tuition? Do you mean out-of-state tuition? Do you mean Ivy League school? Do you mean undergrad, or do you also include graduate school? Do you also include the few years after college where you're still supporting your kids? At what point do you wean your kids off the rolls? Again, that's not for me to tell you. That's for you to tell me. The next goal, retire. What a vague goal. What does that mean? You just sit around, do nothing all day long? So hopefully you guys have given thought and given some definition to what your retirement looks like. What are you going to do? How much it's going to cost you? Because let me give you stern warning. If you have not defined what your retirement's going to look like, an undefined retirement invites deterioration. That's a larger conversation for a different time, but just keep those words in mind. An undefined retirement invites deterioration. Okay, next, start a business. It could be that your federal career was just the first chapter of your career, and you're going to be moving on to something else. If you're going to be starting a business, are there any startup costs? Any licensing? Any overhead? Any revenue? Year one revenue, year two revenue? Again, all these numbers need to be baked into the cake. And the list goes on and on. Get married, start a family, give charity, support parents. You guys could add or subtract from this list. For example, maybe you want to buy a new car. Maybe you want to take a family vacation. Maybe you want to remodel the kitchen, remodel the bathroom. Maybe you want to pay down your debts. Maybe you want to leave an inheritance. Whatever your goals are, the very first step in the planning process is articulate your goals. Get them out of your mind, jot them down somewhere. Just merely articulating your goals is a massive icebreaker, a massive step forward in the planning process. And then after you articulate your goals, the very next step is to convert those goals into dollars and time. So for example, let's say you have a goal to buy a new car. Okay, how much would that new car cost if you bought it today? And if you didn't buy it today, when are you buying it? Are you buying it 2 years from now, 5 years from now, 10 years from now? Because we're going to have to adjust that price for inflation. Oh, and by the way, in your financial plan, are we assuming that you're only buying a car? Is this going to be the last car you buy for the rest of your life? Come to think of it, how often do you buy cars? Every 5 years, every 10 years, every 15 years? Oh, and does your spouse get a new car too? Or is it just you who gets the new car? Oh, it's just you who gets the new car. Okay, listen, it's your plan. We'll do it however you wish. But the very first step in the process is to identify your goals. The next step in the process is to prioritize your goals, meaning you have to go next to each one of your goals and you have to score them. Which goals are more important? Which goals are less important? It'll be an awful shame for a less important goal to derail you from a more important goal. I'll give you guys a great example. So one of my clients is a young couple, and they both have pretty solid jobs. They got a couple of kids. They just bought themselves a new house, their first house. And then they came into my office to do some financial planning. In the planning process, they stated they have a bunch of goals. They have a goal to retire. They have a goal to pay for their kids' college education. They have a goal to take a family vacation every year. These were some of the goals that they shared. Now, in the planning process, I discovered that that first house that they had bought for themselves was not the humble starter house that I usually recommend. For those who don't know, I have a video online that explains one of the things that I encourage my younger clients to explore is when they buy their first house, they should not buy a grand, beautiful, amazing first house that they're going to soup up and make it so wonderful, amazing. No, no, no. I try to encourage, again, I know this is not for everybody, but I try to encourage my younger clients that when they buy that first property, they should go into it thinking that it's going to be a transition property. They're not going to stay there forever. They're going to deliberately stay there just for a few years, just so they can transition into a different property. And when they transition, they're going to keep that original property as a rental property. Now, I realize that's not for everybody. There are many benefits to this strategy. And if we have more time, I could explain all the benefits going into this strategy. But nonetheless, I usually encourage my clients that when they're buying their first house, they should buy humbly, not something that is grand and fantastic, but something very, very simple, something that they're not going to pour a lot of money in, something that's going to be very, very modest, and they're going to transition out of their property and convert it into a rental property. So this young couple that came to my office, their first house was not that humble transition property that I recommend. Their first house was $750,000. Now, I know depending upon where you live, you may say, Stefan, that's all we got. I know some people in the DC metro area, they say, Stefan, that's all you can get in DC. Which, by the way, that's not true. I know there's places in DC that are less than that. And second of all, who says you have to live in DC proper? But nonetheless, this couple, their first starter house, their first house was $750,000. Now, could they afford a $750,000 house? Yes, they could. But that's all they could afford. The mortgage on that property was so demanding. They had less money now available for retirement savings, less money available for college savings, almost zero money for that family vacation. Had they only realized how that one goal of the new home would have an impact on their ability to achieve their other goals, they may have done things differently. So it's very important when you guys are thinking of your goals. And by the way, as I'm talking, if there are any goals that are surfacing in your mind, you may want to quickly jot those down. But as you guys are planning your goals, it's important to score them. Which goals are more important? Which goals are less important? It would be an awful shame for a less important goal to derail you from a more important goal. Okay. And then number 3, identify the resources available to help you achieve your goals. And when I say resources, I mean all of your resources. I remember one of my very first clients, he was a gentleman, he came into my office. At the time he came in, he was 59 years old. And during the conversation, he confided in me that he was very disappointed with himself. And I said, why are you disappointed? And he says, Stefan, I was hoping to retire at 57, and here I am, 59, and I still can't retire. And I said, why can't you retire? And he says, because my portfolio is not yet worth $1 million. I said, so what? He looks at me like I'm crazy. He says, are you kidding me, Stefan? Everybody knows these days you can't retire with less than $1 million. I even read it in an article online, and I printed the article, Stefan. So here, you can read. Here, go ahead, Stefan, read the article. It tells you how much money you need to have by the time you retire. Have you guys ever seen the articles that say how much money you need to have by the time you retire? I've seen the ones that say you have to have $1 million. I've seen the ones that say you have to have $2 million. There's a radio personality in the DC metro area that says you have to have $5 million. I have news for you. Federal employees, you guys could ignore those articles. Those articles were not written for federal employees. They were written for the rest of America. Because you know what the rest of America has for their retirement? They have Social Security, and everything else is reliant on their investments. So they are relying very heavily on their investments. However, you federal employees, not only do you have Social Security, not only do you have your TSP with a 5% match, which by the way is a very, very nice match, but you also have your federal pensions. Some of your pensions are going to be $40,000, $50,000 pensions. Some of your pensions are going to be even more than that. It's true. If you didn't have that $40,000, $50,000 pension, you might need to have $1 million in your portfolio. Yeah. However, because you guys have those pensions, you might not need to have that $1 million in your portfolio. I'll give you a great example. One of my clients, this is a case in point, which by the way, I admit this next example is possibly the most extreme of all my client examples. Okay. However, I use it because it nonetheless illustrates the point. So one of my clients is a married couple. He's a federal employee. She's not. They're in their mid 60s. So married couple, mid 60s. He's federal employee. She's not. They have a net worth that is just above $300,000. You know what that means, net worth? Net worth means you take all their assets, you subtract their liabilities. The difference is the net worth. Their net worth is just above $300,000. Now, if I was to ask any financial advisor in America, whether a married couple in their mid 60s, net worth just above $300,000, would they have the ability to retire? You know what the financial advisor would say? No chance. What are you kidding me? No chance. Impossible. Well, I ran their numbers and their score was a 99% success. 99%, which by the way, that's the highest possible score. The program doesn't give it 100%. The highest possible score, 99% success. They were scoring the highest possible score. How's that possible? Well, did I mention he's a federal employee? He's been working in the DC metro area for decades. He's got this huge $65,000 for his pension. In addition to that, he has Social Security, $35,000. His wife also Social Security, $35,000. 65, 35, 35, that's $135,000 of fixed income. Their expenses, thankfully, were relatively low. Their expenses, $80,000 expenses. So $135,000 fixed income, $80,000 expenses. Is anybody noticing what I'm noticing in this situation? How much are they relying on their investments in this situation? And the answer is zero. They're not relying on their investments at all. Their fixed income is more than enough to cover the expenses. They're not relying on their investments at all. So who cares that their net worth was only above $300,000? Who cares that they didn't have $1 million in their portfolio? Who cares? My point is that federal employees, you guys have resources that the rest of America would only dream about. You guys are a completely different financial planet. The rest of America would only dream to have the resources that you guys have. Oh, and that's just one federal employee. One federal employee puts you on a different financial planet. You know what happens if you deal with two federal employees? You'll be in a different galaxy. You'll be so far away. I can't even see you, you're so far away. Now, with that being said, if there are any single federal employees on this call right now, You may want to introduce yourself to the other single federal employees on this call right now. Make the magic happen. I'm not joking. 2 federal employees, you will be untouchable. What do I mean by untouchable? You will never touch your investments. I have about 14, 15 clients that are married federal employees. That means both the husband and wife, both of them, federal employees. The common denominator, they'll never touch their investments. Their fixed income is so strong, they just don't need to touch their investments. So, step number 3 is identify all the resources. When I say your resources, I mean your federal pension, your Social Security, your some of you have a military pension, some of you have VA benefits. If you're married, does your spouse have any pensions or Social Security? You have your investments. Does your spouse have investments? You probably have cash in the bank, equity in the home. I want all these resources in mind when we are producing your financial plan. And by the way, it could very well be that if you have sufficient resources, meaning you have your first pension, Social Security, and you have sufficient resources already in your investments, you might not need to be building your investments further. There are some situations where I tell my clients, you don't need to save any more money. You could actually afford to start spending money. Okay, next, identify the obstacles to achieving those goals and then clearing those obstacles. You basically have to ask yourself, what could possibly go wrong? And there's always something to go wrong, right? You cannot protect every single thing, right? But most of the things that could go wrong, we could protect with the various insurances that we have. Have you ever marveled at how many insurances we have? Health insurance, life insurance, long-term care insurance, dental insurance, vision insurance, auto insurance, homeowners insurance, liability insurance, identity theft protection. And then there's the classic self-insurance. Self-insurance, which is a topic for a different discussion, but self-insurance essentially means that I may not be needing to buy an insurance policy. I might be able to cover the insurance need myself. If something goes wrong, I'm able to cover it myself with my assets. And as we will see, I'll show you the common area that people are able to self-insure. I'll show you that in just a few moments. So the next step is identify the obstacles to achieving goals and clearing those obstacles with the many forms of insurance, whether it is commercial insurance or whether it's self-insurance. And then last but not least, synchronizing offensive and defensive strategies. Meaning, if you could do one motion which accomplishes both an offensive result and a defensive result, that is efficient use of your money. So, for example, my concept of self-insurance is a synchronization of offense and defense. Meaning, in order to self-insure, you have to have grown your assets. Growing your assets is an offensive move. However, by you growing your assets, you're then able to use those assets to defend yourself in case things that go wrong. That's a form of synchronization of offense and defense. And there are other synchronizations. For example, if we have a chance to talk about debt, if we have a chance to talk about taxes, those are areas as well where someone could do something that's both offensive and defensive in one stroke. So if I was to summarize this slide one step further, I would say the objective of financial planning is to grow your money so that you could achieve your goals with as little inefficiency as possible. Let me say it again. The objective of financial planning is to grow your money so that you can achieve your goals with as little inefficiency as possible. If you guys are hearing what I'm saying, there's really 2 major takeaways from the planning process. Number 1 is, can we achieve those goals? That's measuring feasibility. That's a major, major step in the planning process. Can you achieve your goals? Can you retire? Can you take that family vacation? Could you build that new house? Can you afford to send your kids to this ideal college of choice? And by the way, when I measure feasibility for my clients, I also throw in curveball scenarios. What do I mean by curveball scenarios? For example, what if somebody dies early? What if there's a long-term care event? What if your expenses are higher than what we thought? You know, we thought that they were X, but they're really X plus plus. And by the way, we could stress test how high your expenses go before the whole plan starts unraveling. That's one of the steps we do. How high can your expenses go before it's just not doable anymore? So that is a major takeaway from the planning process, which is measuring feasibility. The other major takeaway of the planning process is removing the inefficiencies. And as I'm mentioning, the inefficiencies, what I'm referring to, those are the areas where people are losing money unnecessarily. And I have found by working with federal employees, there are 4 common areas of inefficiency, meaning there are 4 areas where I find usually on a consistent basis, federal employees are losing money in these 4 areas consistently. The 4 areas of inefficiency where people are losing money unnecessarily. Number 1, debt. I know what you're thinking. You're thinking, obviously, debt's inefficiency because debt is costing you money. So obviously, that's inefficiency. Whoa. When I say debt's inefficiency, I'm not only talking about having the debt inefficiency, but very often I'm talking about the way we get ourselves out of the debt. That's the inefficiency. Especially pre-retirees. If there's one thing I've seen about pre-retirees, many pre-retirees have this mindset that they want to be debt-free by the time they retire. And as a result of that thinking that they want to be debt-free by the time they retire, whenever they find extra money available, they start throwing it at their debt because they want to be debt-free. They say, Stephan, please help me get out of this debt. I can't stand this debt. It's driving me bananas. Please help me get out of this debt. And believe it or not, the way they get themselves out of the debt ends up costing them more money than it saves them. I'll give you one easy, obvious example. Does anybody here have one of those mortgages with a super low interest rate on it? I know some of you carrying a 3% interest rate on your 30-year mortgage. Some of you 2.875. I met a veteran with a VA loan, 1.99 on a 30-year. And yet, I'm meeting pre-retirees that they want to rush to get themselves out of those debts. And so whenever they find extra money, they start throwing at their debt. Please tell me, what is the rate of return you are achieving when you accelerate payments on that mortgage, which has a 1.99 or a 3% interest rate? What is your rate of return? It's 1.99 or 3%. It's the rate of interest that you just avoided minus the tax deduction. So that means your rate of return is 1.99, 3% at best. Please tell me, was there nothing better you could do with your money? Nothing better? Even the G fund right now is outpacing that. So the first area of inefficiency, debt. The second area of inefficiency, investments. And when I say investments are inefficiency, my biggest gripe is when people make positions, or let me say this, is when people position their TSB, they invest their TSB without coordinating the TSB with their other financial resources. So for example, when you position your TSB, did you coordinate your TSB with your IRA? Did you coordinate with your 401k? Did you coordinate it with any of your other investments? Or let me say it a little bit stronger. Did you coordinate your TSB with your FERS pension and your Social Security? Believe it or not, your FERS pension and Social Security will have the biggest impact on the way you position your TSB. It's not even close. It's not even close. And I'll tell you why. Because as I gave you guys an example earlier of my clients whose fixed income was so strong, they were not relying on their investments at all. So here's the thing. If you're not relying on your investments at all, that usually gives you more opportunity to be more aggressive with that money. The general rule is the more you're relying on your portfolio, the more conservative you need to be. The less you're relying on your portfolio, the less conservative you need to be. That's the general rule. Obviously, there's always exceptions. So if I find somebody who's not relying on their investments at all because their fixed income is so strong, well, that tells me that they could position their portfolio very differently than somebody who does not have a strong fixed income. And they're going to be relying heavily on their investments. The approach must be very, very different. So anybody here who has a fixed income, whether it's your FERS pension or Social Security or military pensions or VA benefits or whatever other fixed income sources you may have, those fixed income sources are taking pressure off your investments. As a result, You might be able to position your investments differently. But again, this is all part of the planning process. This is all part of the discussion that needs to be had. The third area of inefficiency, taxes. And there are so many areas where people lose in taxes unnecessarily. A classic area is Roth versus traditional. And by the way, the Roth versus traditional conversation is not just what you should do before retirement, it's even what you should do in retirement. A whole discussion as to whether or not you should do what's called a Roth conversion. The objective, obviously, is to minimize your tax hit. And there are other areas where federal employees are overpaying in taxes. So, for example, have you guys ever heard of the FSA? That's a great vehicle. It could save you in taxes. Have you also heard of the Lex FSA? Not too many people have heard about that. One of the best kept secrets in the federal government. Also, another opportunity for you guys to save in taxes. Have you guys ever heard of the HSA? Another all-star, amazing instrument where you could be saving taxes. And I find that people not knowing about these instruments or misunderstanding how to utilize these instruments, they're either not participating or they're participating incorrectly. There are other areas where people could save in taxes. For example, does anybody hear of any investments that are not in a retirement portfolio? Not in an IRA, not in a TSB, not in a 401k. Does anybody hear of any investments that are not in a retirement account? Well, if your investments are not in a retirement account, that probably means that they're what's called a non-qualified investment. And non-qualified investments have different tax treatment. They have long-term capital gains tax rates. They have harvesting capital losses. They have stepped up cost basis. So these are areas where people can actually save in taxes with their non-qualified, with their non-retirement investments. Next, insurances. The fourth area where people are losing money unnecessarily. Insurances. And I find that amongst insurances, there are 4 insurances which you probably don't either need a full amount of, you could probably do a reduced amount, or you might not need it at all. And again, this is going to vary from customer to customer on a case-by-case basis. But I find many federal employees are pleasantly surprised when they discover that they no longer need life insurance. You thought you needed life insurance. When you were younger, you needed life insurance. But it could very well be that you reach a stage of your life where you no longer even need life insurance. Long-term care insurance. Do you need long-term care insurance? Some of you may be pleasantly surprised when you discover that you have the ability to self-insure. I'll give you a great example of the first two, of the life insurance, of the long-term care insurance concept, of the self-insurance. I'll explain. So one of my clients is a single lady. She's age 60. She has 1 child. The child is age 35, married, completely independent. And yet, this mother is carrying 5 multiples of FEGLI, which is very expensive. For those who know FEGLI, the Federal Employee Group Life Insurance, when you get to age 60, 5 multiples, very expensive. So I looked at her and I said, why are you carrying all this FEGLI? And she says, Stephan, because I want to make sure that if I pass away, I leave something to my daughter. I said, oh, okay. Aren't you going to leave your TSB? Aren't you going to leave your house? Aren't you going to leave your bank accounts? Aren't you going to leave your entire net worth? She looks at me and she says, oh yeah, that's a good point. But I followed up and I asked the next question, which is the really important question. I said, you know what? Let's imagine you pass away and you leave your daughter with 0, nothing. How detrimental would that be to your daughter's financial situation? She looks at me and she says, detrimental? I don't know if I call it detrimental. I mean, because after all, she's completely independent. I looked at her and I said, congratulations. You're self-insured. And again, same thing when it comes to the long-term care. It could very well be that if a person had a long-term care event, you're right, it's going to eat away at their assets and there's going to be less money for the next person in line. But if the next person in line is a totally independent, self-sufficient person, you might not need to leave that person your resources. They might not need it. It might not be detrimental to leave them nothing. Now, you may say, Stephan, it might not be detrimental, but I want to leave them something. Okay, so then we have to think of a strategy to make sure that we preserve assets for the next person in line, which again might not require a long-term care insurance policy. Next, health insurance. And when I say that you could self-insure when it comes to health insurance, there's really a couple of ways you could self-insure when it comes to health insurance. Number one is very simple. Suffice with one health insurance, and you may not need to get a second health insurance. What do I mean a second health insurance? So the common example would be Medicare. You guys are federal employees. You have FEHB. Do you need to have Medicare with your FEHB? Believe it or not, the answer to that question boils down to your willingness to self-insure on your out-of-pocket exposures. What do I mean? Well, if you have one insurance, you'll have out-of-pocket exposures. If you have two insurances, usually whatever the first insurance doesn't pick up, the secondary does, in which case you have zero out-of-pocket exposure. But you had to pay for the second insurance. Was it worth it to pay extra money for that second insurance just to have zero out-of-pocket exposure? And the answer obviously is, well, what was your out-of-pocket exposure with your first insurance? And what was the cost of the second insurance? And if you do a cost-benefit analysis, you'll be able to see whether it's worth it to pay for that second insurance, or can you just self-insure? Another way you could self-insure is by raising your deductible. Does anybody here have a deductible on any insurance? Health insurance, on your auto insurance, on your homeowner's insurance, on your long-term care insurance? You have deductibles. Now, here's the thing. A deductible means the amount of money that you're going to cover first before the insurance starts paying from their pocket. So basically, the deductible is the amount of money you're going to pay from your pocket first before the insurance pays anything from their pocket. So what that means is the lower your deductible, that means you have to pay means you first have to lay out a little bit of money and the insurance kicks in sooner. If you have a high deductible, that means you have to pay more money and the insurance kicks in later. Now, if you're following what's happening, the deductible is the amount that you are covering. And by you having a high deductible plan, that means you are willing to cover more of the expense. And you know what happens when you raise your deductible on your insurance? It lowers the premium. It lowers the price of the insurance policy. So by you self-insuring, it makes the insurance less expensive for you. By you raising your deductible, it lowers the cost of the insurance. And then last but not least, the fourth insurance, which federal employees usually do not need. And again, when I say usually, are there exceptions? Of course, there's exceptions. But the fourth insurance, which federal employees usually do not need, are annuities. Annuities. Do you really need another annuity? And I tell you guys this, I tell federal employees that you probably don't need another annuity because I know that right now, as we're talking, there are hawks circling your house, waiting for you to step outside so they can engage you in a conversation about how you desperately need another annuity. Go ahead, look out the window. Look, oh, there they are. There they are, the hawks on the outside. But there are even hawks on the inside. There's not just hawks on the outside, there's even hawks on the inside. What am I referring to? I'm talking about inside the federal government, there are people trying to sell you annuities that you might not even need. I'll give you an example. Have you guys ever looked at your TSB statement? Did you ever notice on your TSB statement, the year-end statement, did you ever notice that there is a page of that year-end statement that is dedicated to selling you the TSB annuity? Did you ever notice that? A page dedicated to selling you TSB annuities. So it's not just hawks on the outside trying to sell you annuities. There's even hawks on the inside. Did you really need another annuity? What do I mean another annuity? Well, as we mentioned, you already have your pension and Social Security. Those are already two government-backed annuities. Did you really need a third annuity? I find federal employees, usually the answer is no, they do not. Again, there's exceptions to every category, but my objective over here is to help you guys stop losing money. These are areas of inefficiency where money is dripping through the cracks unnecessarily. So when I meet with clients, I have clients that say to me, Stefan, I know I could retire. I can easily afford to retire. So the question is, well, if they can easily afford to retire, what do they want from me? And the answer is, and this is what they sometimes tell me, or this is what I need to explain to them. The answer is, we're not just measuring your ability to retire. We're not just measuring the feasibility to achieve your goals. What we're also doing is we're making sure that we remove any inefficiencies, any areas where you're losing money unnecessarily. And for some people, that stings, that burns a little bit more because they realize, man, I lost thousands and thousands of dollars over the years. Can we stop the bleeding, capture those losses, and put the money to work so we could accelerate not just our net worth, but also accelerate our ability to achieve our other goals? This is financial planning at its finest. And I would encourage you guys to start the planning process. As I mentioned, if anybody here needs help in the planning process, what you should do is you should reach out to me and send me a meeting request. There is that button on the sidebar. If you guys see on that sidebar, there's that button that says learn more. So you could click on that button. It'll take you to a web form. And on that web form, you can fill out and request your meeting, and we could get you starting on the planning process. I would encourage you guys to do that now. I know that some federal employees over the past 2 or 3 weeks, they were scrambling to do financial planning, but their deadline, they only had, a couple of days to make this decision. So it's much better to do a planning process when you don't have only 2 or 3 days to make the decision, where you have some time and some ability to collect your thoughts. I know some of you took the deferred resignation and you're planning on retiring at the end. So you may be retiring at the end of September this year. Some of you are going to be retiring at the end of December this year. And you may say, Stefan, I know I could afford retirement. And my response to you is, great. Even if you could afford retirement, are there inefficiencies which are costing you money? And it's always good to make sure that you do the planning process correctly. I know usually when you have married couples, usually one of the spouses is very on top of the finances and the other spouse is clueless. So very often it's good to have another person who could explain to the non-financial spouse what's going on, and another person who could be a resource to that non-financial spouse in case the first spouse is no longer around. Many, many benefits of doing the planning process and doing the planning process right. So if you guys are seeking a financial plan, don't just look for somebody who's going to give you a free financial plan, because they're probably just going to say, here's your free financial plan. Now you should go buy a product that you don't even need. Instead, you should look for a planner that is familiar with federal benefits and can help you measure the feasibility of your goals, and also throw in curveball scenarios, and also remove the inefficiency from your financial lives. That is the planning process in a nutshell. I'm going to turn over the microphone, or not the microphone, excuse me. I'm going to turn over my attention. I'm going to turn my attention to the chat box. I see I have some questions waiting from the chat box. I see Kara has a question. Question is, right now, our federal jobs are in jeopardy. Should we move our TSP funds to G Fund if we may lose our job? That's a great question, Kara. So let me talk about that. First of all, I have had some people say to me, Stefan, Doge is raiding our TSP and we're going to take away our TSP. Let me be very, very clear. I do not subscribe to that at all. I do not subscribe to that at all. My wife is a federal employee. Her money is in the TSB. We have not moved her money out of the TSB. Okay? So I am not concerned that Doge is going to come in and steal your TSB at all. That is not a concern. Now, as far as moving the money to the G Fund, so the answer to that question is, well, how soon do you need the money in your TSB? I know some of you are going to be retiring soon. Some of you may be forced to resign soon, and you might need some transition money. Is that transition money only in your TSB, or do you have transition money outside your TSB? Because it could very well be that you have money outside the TSB. That could function as your transition money. But Kara, if you have no money outside the TSB and you're going to be relying on your TSB for a transition period, then the answer is yes, you probably should have some of your TSB in the G Fund. Now, how much of your TSB should you G Fund? That's going to vary from person to person, and it's also going to vary depending upon how much of a transition period they need. So your thinking is correct that if I need the money, I may need to set aside a transition money. However, the transition money does not need to be in the TSB. It could be outside the TSB. And even if it is in the TSB, it might not be your entire TSB to be in the G Fund, but it might just be the money that you're going to need over the next transition period, however long the transition period takes, whether it's 1 year, 3 year, 5 year. So that's a conversation we need to have. I see Neil is asking a question. Will we have to pay for Medicare B to keep our FEHB? So Neil, right now, the answer is no. Right now, federal employees, civilian federal employees, you are not being forced to have Medicare Part B with your FEHB. That's great. However, Neil, let me point out to what happened with postal employees. So in 2022, President Biden forced postal employees to have Medicare with their FEHB, meaning in order for them to continue FEHB, they have to have Medicare. That's for postal employees. Now, will the same thing happen to civilian federal employees? And the answer is, I have no clue. Maybe yes, maybe no. As of now, the case is no, that's not the case. However, we do have a precedent that it has happened in the past. What was nice about that precedent is that when they forced the FEHB people to get their Medicare, I believe, if I remember correctly, there was a waiver of the penalty for enrolling late. So some people did not have Medicare. They were late to the enrollment because they figured they'd have FEHB without being forced to get Medicare. I'm pretty sure, if I remember correctly, there was a waiver of the penalty. So that may be a nice precedent that we saw. If they ever force you, they might waive the penalty. Sherry's asking, can you withdraw only from the G fund of your TSB? No, Sherry, you cannot. Now, Sherry's basically saying, Stefan, but according to what you just said a few seconds ago, if I need a transition money, my transition money should be in my G fund and everything else should not be in my G fund. Oh, okay. So, but according to what you just said now, based upon Sherry's question, I cannot specify the withdrawal come from my G fund alone. So even if I do have a transition fund in my G fund, I can't take the money just from my G fund. It's going to come from all my funds pro rata. You're right, Sherry. I have two solutions to that. Two solutions. Solution number one is, you're right. When you request a withdrawal, they're going to send you from both, from all your funds pro rata. So that's going to be G fund. It's also going to be from your other funds, C fund, S fund, whatever you may have. So they're going to send you pro rata, which is not what we want. So guess what? Right when they send you the money pro rata, you know what you need to do? You need to log into your TSB and do an inter-fund transfer so that you rebalance your portfolio to the correct percentages, to the correct allocation. It's not perfect. There's a little bit of a lag, but nonetheless, that is one workaround. They're going to send you pro rata, which is not what you want. Right after they send you the pro rata distribution, you're going to have to log in and rebalance your portfolio to the correct allocation. That's workaround number one. There is a second workaround, which is that you're right, they're going to send you a pro rata distribution. That's not what they want. So in order to get around this, you're going to have to move one of your funds, whether it's the aggressive money or the conservative money, one of those funds is going to have to be moved outside the TSB into an IRA, usually into an IRA. Now, which fund should you move outside of the TSB? Should it be the aggressive fund that you move outside the TSB? Should it be a conservative fund outside the TSB? And the answer is either one. So long as one of those funds is removed outside the TSB, then you could be selective. Okay, so that should be able to address that point. I see Kara has a different question. Kara's question is, if there are any referrals for a good federal employee attorney. Now, are you talking about an employment attorney? What type of attorney are you talking about? But in general, I'm not going to be able to use this platform to give recommendations for other attorneys. I would definitely say you should reach out to me, and I could connect you with my network, or if you know somebody else on this call, you could be connected with their network. Fantastic. Amazing, amazing, amazing. All right, I want to thank you guys for hanging out with me. And again, I know that we're in some really unusual times right now, really, really interesting times. And for some people, high stress, and for some people, a lot of pressure. And I would encourage you guys to don't wait for the last moment to do any form of planning. I would encourage you guys to start the planning process now. So if you're interested in getting together, as I mentioned in the chat, in the side box over there, you'll see that green button on the side where you could request that consultation. Go ahead and click that button now, request your meeting, and we will get you scheduled and get you started as soon as possible. Good luck to you all. I wish you all blessing and success. All the best, everybody.